person A and person B. With person A is with a modest salary and person B is a very high salary. With a modest salary, have you seen any person to create a huge wealth over the period of time?
He started with 5,000 rupees SIP, a modest amount. Believe me or not, today he possesses close to 5 crores of assets.
Many people think that financial success is all about intelligence. What do you think?
I think the key word in this is discipline. You might be superbly intelligent, you might be, if you don't have discipline in your investment journey, there are larger chances that you will fail.
If you look back in your 20s, what do you think that what financial mistake you did?
For 4 or 5 years, I didn't make any investments. I was largely spending on travel, trips, accessories and stuff like that.
Why do we see that intelligent people often makes a poor financial decisions?
Intelligent people might be intelligent in their domain. It's not necessarily they have every knowledge in terms of finance.
Someone like a 25 years or 27 years, if they want to buy a house, should they buy or should they be on rent? Wealth or freedom?
Freedom.
One financial habit every 25-year-old should start today. Welcome to Bridging Ideas. Today we have Mr. Saibal Biswas. He is a financial advisor and he manages the portfolio of about 1100 CR. Welcome to the show.
Hi.
How are you?
I'm good. Thank you for inviting me here.
Great to have you here. It's our pleasure. You have advised investors for over the 3 decades. And what is the biggest misconception you see from investors?
So initially, when we started this journey and started interacting with investors, we felt that there was a clear confusion between investment and savings. So people considered savings as investment. But let me clarify a bit.
Yeah.
So when you save, your earnings don't beat inflation or equal to inflation, which means you're not actually growing your portfolio. So maybe if you put it in a fixed deposit and your post-tax returns are equal to your inflation number, then you're actually saving. You're not investing. Investing is when you start putting your money in asset classes which gives you that additional income or additional growth over and above that inflation. So we saw clear, misconception that they were doing investments, whereas many of them were doing savings. Second is there was also a confusion with people that what is the difference between protection and investment.
Okay.
A lot of people considered insurance to be an investment product, but largely insurance should be considered as a protection plan, whether it be Mediclaim, whether it's car insurance, it's a fire insurance, and so with life. But people, so people considered that to be an investment vehicle rather than a protection vehicle. So these 2 great misconceptions were there in people's mind, and over time and with education and the kind of spread of financial knowledge that is happening, that I think is slowly getting eradicated. It's not got eradicated yet, but we are in progression.
It's still in the
pipeline.
Pipeline.
Yeah.
And as you said that savings and investments are very different thing. If I talk about the traditional 30-20, 50-30-20 rule, in today's date, is it still valid or it is been modified because of the time? Like 50% for the need and then 30% want and 20% is saving, which is, traditionally theory says, right? We at least what we hear from the influencers these days, or even the book also says that few of the books. Is it still valid or it's changed?
Yeah, academics wise it is valid, but end of the day it is so fitted to each person's wants, needs, aspirations, risks, etc. So sometimes in our journey we have to break this down. The theory had to be broken. Because sometimes you need to save more because your future needs might be higher. Sometimes your expenditure needs could be higher because you have liabilities in hand. So this fixated rule of 50-30-20 needs to be actually broken and recalculated. I have had many experiences when people have huge aspirations, their incomes are limited, then they have to push for their savings much more than what is desired to be done. So in these circumstances, they have to kind of push
Modify
for
it.
their savings, modify that ratio. Second is there are people also who are very rich, might feel that in the future they will get a legacy from their parents, etc. They might want to expand more and save more because they know there is something in the pipeline coming their way. So in general, you might say there is a rule, but one-to-one discussion, and when we discuss with clients how they want to do this breakdown, there is quite a variance that comes.
Quite a
through.
variance. And I'm sure this again will depend on the goal what the person have.
Absolutely.
Like if the goal-based things can be calculated, then I think this needs to be reconvened and reconciled.
Absolutely. So everything that you do in terms of wealth management is focused on your goals. So there are two categories of people that are available. One are who are very rich and they say, I don't have any goals. My only goal is to grow my wealth.
Okay.
So you do wealth management for them purely. But the rest of the people, I think it is important to do financial planning. That these are your aspirative goals and this is where you want to reach after X period of time. How do you go about that? What is the process flow that you do? Do you add inflation numbers to the costs that are available to your goals now? So those things need to be planned and investment needs to be planned accordingly so that you can go and reach those goals.
And while doing this, when you see that, okay, this person needs to have some investment vehicle in such some asset classes, how do you do this when you do the first financial assessment of someone? What I meant is the person is good to go for SIPs or the person is good to go for some other asset classes. What are the things you consider while you do this analysis and go for
So the few parameters I think every financial person who's looking after portfolio should look at is primarily the risk appetite of a person. And this is a very difficult subject to probe. Risk varies consistently over time. So you need to assess that risk. And sometimes just filling up a form and assessing risk is not the final verdict. So the risk needs to be assessed by continuously talking to that person, that how would he react to different situations. Once you have assessed the risk, you know what kind of risk products that you can spread your assets into or the money into. So that is one way of thinking. The second way is thinking what is the distance of time that is left for his goal to be reached. So what kind of instruments can you use? If it's a very short period of time, then you can't use a very risk asset because it will be volatile over that period of time. So you continue to give him a less riskier product. So one is time. The third is what is the kind of income expenses that he has overall. What is the kind of liabilities that he possesses, what kind of assets that he has in that. So risk, the duration of the goal that is available, the kind of asset liabilities that he has, kind of defines what kind of products that will fit to him. You can use an SIP in an equity fund for a long distance investment, maybe child's education when the child is small. When the child is going for his college 2 years down the line, you might not be able to use that kind of instrument. You have to use something far more less volatile to use. So these few things, I think, without complexing things, these few things I think should be kept in mind before you kind of address his cash flows also of course.
Of course, because time, like compounding works better with time, not with the amount as what we see.
That's right.
In many cases, many people think that financial success is all about intelligence. Now, in your experience, what do you think that a financial success is about time, about temperament? Why temperament? Because to be invested in difficult times, or it is something else beyond all of these things?
I think the key word in this is discipline.
Okay.
You might be superbly intelligent, if you don't have discipline in your investment journey, there are larger chances that you will fail.
Okay.
Because markets will have different time frames. Market will have different scenarios. We'll have wars, we'll have economic turmoil, etc., etc. If you cannot consistently go on investing and keeping your mind calm, then it will be difficult for you to run this journey. I've had many experiences when people pull out at the wrong time because they feel that there is too much of volatility they can accept. But if you have discipline over longer periods of time, then it is quite evident in history, it has been seen that people make more money than the others. You might be superbly intelligent, you might have picked the best of stocks, you might have picked the best of funds, but if you are not disciplined enough, you will not make the best of money. So I think the primary thing that one requires, intelligence, etc., can all back it up. But I think the primary thing that is important in this is discipline.
It's discipline. So discipline is the key.
Is the key word.
Now, in the same line, as you said, discipline is the key. And I'm sure you have seen such instances, as you said, like say person A and person B. With person A is with a modest salary and person B is a very high salary. Now, with a modest salary, have you seen any person to create a huge wealth over the period of time?
I'll give you an example.
Yes. Please.
So I had a client who's, and I'm not naming anybody, is to work in a multinational company. And he started with 5,000 rupees SIP, a modest amount, and started building on it. And his income was not growing at the same manner, but he was slowly cutting his undue flap of expenditure to build this. Believe me or not, today he possesses close to 5 crores of assets.
Oh my God.
In his books. And he's got a property which is loan free.
Wow.
Sheer discipline and sheer fact that whenever he had an enhancement of salary, that salary's a large percentage would go back to investments.
So he started with, like, getting back to this again. So he started with 5,000 for investment. And you said that he increased that amount gradually from 5,000 to, let's say, 6,000 or 7,000, like that he increased. So basically what he did is a step up for the investment. And which tool, since it's your client, which tool he was invested in?
So largely in equity, because equity is something which beats inflation over longer periods of time. So 2 things was important for him. He started early. That was also extremely important. As you said, compounding is so important, and when you start early, you can have that time frame to compound.
Yeah.
So he started early. And whenever he had an enhancement of salary, he was building on that SIP and not making unnecessary expenditures. Okay. Also, he was trying to see which expenditure he could save or take least amount of loans so that he could pass that through to investment.
And which year he started this?
Now it's around 20-25 years back.
25. So if we see the stock market, that is Indian stock market, has grown from what level to what level, I think this is
so it's a significant. So I feel this is significant because he was not, in his initial journey, he was not getting a handsome, huge pay package. In spite of that, he went on building his wealth. Of course, he grew in his career in a later half of the life. But, this habit of building on your investments and continuing to grow the investments is an important aspect of this journey. Once you have done that, then you might see, and I've seen many people who are contemporaries to him, has not built that wealth. They were more successful sometimes in career, but they have not built their wealth. Today I met somebody in office who came and said that I've not been able to build wealth because I'm expending everything. I'm going for a higher bracket of car, I'm going for a better mobile, I'm going for a better house. In all these, I am actually not building my wealth.
And either they are not able to invest because of all of these things, or even if they are invested, then they are not able to increase it. They are not able to make the step up of it.
Normally what happens in this journey, whenever you get some kind of a bonus, some kind of an enhancement, your perk of demand kind of brings the demon out of you. And it says, let's spend this. because something which I've got extra kind of a thing. Let's go ahead and spend this.
Let's fulfill the desire.
Let's fulfill the desire. Let's go to Paris,
Yeah.
let's say. I'm not saying that you should not have any of those desires. You should. But I think your goals need to be well met, and then you must fulfill all your desires. Because sometimes it also happens that maybe 2-3 people are dependent on you. When I started my journey, my son was dependent on me in terms of finance. Now, if I blow everything on myself to fulfill all my dreams and aspirations, I might blunt his. So it is important to balance that. And I think plan for your aspirations. I have no problem in that. But make sure that our basic goals are well met.
Right. And since you talked about your financial journey, about your son was dependent at that time, if you look back in your 20s, what do you think that what financial mistake you did?
Oh, I made all the mistakes that
How
are
many
possible.
times you burnt your hands in mistakes?
Oh, first of all, I didn't start investing at the time that was required. I joined my job a very early date. So I was only 21, 22 when I started my career. But first 5 years, it was all the pent-up demand that I blew on my money. When I'm saying all these things, I've learned from my own self that what you should not do sometimes. So 4 or 5 years, I didn't make any investments. I was largely spending on travel, trips, accessories and stuff like that. Then I also used asset classes which I shouldn't have put my fingers on. It was a way of making quick money, etc. But at a point of time when I reassessed my position, when I was 30 odd, I said, I have not got anything. And I was earning, and I was earning well because I was working for a multinational company, a foreign bank. But where was my bank balance going? Then I reassessed my positioning and said, how many years have I left in this journey? And who are dependent on me? What are my liabilities?
That was the eye-opener.
That was the eye-opener.
And which year it is?
This is when I was 30, so it must be around 2000 odd. And, I shivered one night, just thinking that where is the money? Tomorrow, if anything happens to me, or tomorrow, if I kind of think of something else, I lose my job or whatever happens, where is the money? And where is the visibility of money growth as well?
True.
So then I thought that, it's high time that I kind of changed my outlook, and I started saving in small bits. And as they say, you start building money over money, and you continue to build brick by brick. And I did the same passage as I was talking about this client, same manner I was building my wealth.
And I'm very interested to know one thing. As you said that first 4 or 5 years you did not even invest, you were more into your fulfilling your desire. But then you said you were into something on quick making money. So what were those you tried?
So I tried different kinds of equities without that enough knowledge. Even later on, I tried with derivatives without having enough knowledge. Somebody was coming and saying, this is the hot stock, please pick it up. And
Tips-based investing.
Tips-based and very dangerous ones.
Very dangerous.
Because if you don't have enough knowledge, I don't think equity is your cup of tea. Because, one that there are many stocks which you will not know. You will not have the ability to research those stocks. And then there are very good stocks, but you don't know what price to pick them up. So if you look at today's scenario, for example, there are many large cap stocks, which are excellent stocks per se, but the pricing is all gone wrong. The people who have bought them and sitting on them for long periods of time. So I tried to experiment with a few, thought that everybody was making money, so I could easily make money. But I think without fair amount of knowledge and expertise, I think that should not be the process flow.
And if you could go back to your younger self, what are the 3 things you would tell yourself? One, I got it that, okay, start investing from the very early.
No, that's one part of it. But I think there are many things that I could have done. One, that I should have been more disciplined. 2 is that I should not have taken any loans at the beginning of my career. I should have first built my wealth to a greater extent. And third, I think you should also devote a lot of time to yourself so that your ability to make money also grows. I think these three things, I think everybody should concentrate on.
Why do we see that intelligent people often makes a poor financial decisions?
So, intelligent people might be intelligent in their domain. It's not necessarily they have every knowledge in terms of finance. Finance is a different sort of a knowledge that one should have. So they feel that they are successful and intelligent in their field of work, and they feel that the same can be replicated in any field.
Which doesn't
That's
work.
not what works. I'll give you an example. That day my Sasoma's fridge got disrupted. So I said, what the heck? It's so easy today. I'll Google it and I'll fix it. So I immediately Googled it. And it said, do this, do that, do that. I did everything possible. Nothing worked. So I had to get a specialist the next day who I think pressed a few buttons here and there and it got operated. So, your field, your skills, your knowledge cannot be replicated in any other field that easily.
That's right.
You might be inherently intelligent, but that does not mean that you will be financially savvy as well if you don't have the knowledge.
Right, right. Very true, very true. And if we see the high-paying jobs, for example, the professions, not the jobs, like doctors, engineers, lawyers, we see them to park their money in some specific vehicle, not all the asset classes. If not all, but at least few. Why do they want to stick to some particular asset classes, some traditional asset classes over the new thing?
So I think there are two sides to this. One, they don't have enough time to devote and understand how the asset division must happen. Even sometimes they don't have the time or the trust in professionals who can actually guide them through that process.
Right.
So they feel that they should park it in asset classes which do not go down, visually don't go down. I'll give an example. What visually does not go down does not mean are doing very well. So if I give you 100 rupees today and you put it into your almirah and bring it out after 20 years, what will you get?
100 rupees.
Right. So visually, you have not lost a single penny. But is the purchasing power of that 100 rupees the same after that 20 years? Nothing. So sometimes people feel that I want to park it in a safe area. I don't need anybody's advice. So I park it in a place which does not even cover inflation and tax. So visually they look that they are same in value, but they are going down in value all the time. So with very high-end professionals who don't have time, don't want to recruit people who are professional, or they don't trust people who are professionally equipped to handle this, mostly park their money in areas of safety which they think will not lose value, but actually they're losing value.
Actually, they will lose. And have you ever seen, like, anyone who created the wealth for the years, but then they destroys because they wanted to time the market?
Oh, many times. Many times.
And how does it work? Like, what to avoid to do all of this?
So sometimes when they build a significant amount of wealth, people stop being disciplined. People think that they've got a sizable chunk of money and they can quickly experiment with that money and get a bigger chunk. We know that money makes money, but doesn't mean money will make disproportionate amount of money every time, everywhere. So I've seen I don't know whether we have heard that story about that KBC winner who got a lot of money.
Yeah, we heard.
He spent it here, there, invested here, there, and
He's
became
back to
a
circle
pauper again. So he has to again go back to KBC to get that money again if he can get an option. So what I'm saying is, people lose that discipline when they make a sizable amount of money, and sometimes they completely destroy it in the greed of making more money. So fear and greed are part of this investment journey. We are always fearful. When the markets are down, we are very fearful. When the markets are up, we are extremely greedy. So sometimes the greed takes over us and we lose our discipline, and that's where you blow out money.
And that's the reason it is said that the people who are invested into market, 5% of financial literacy and more, 95% is the temperament, the patience, the discipline.
Yeah. So, I mean, our job, if you ask me, 5%, 6%, 10% is knowledge backed. 80-90% are behavioral management. How do I control your behavior? Because every time a client will come up and say, "Arey, Pujoy, so let's pull out some money from there and I want to go for a holiday."
Yeah.
Yeah. So these are behavioral aspects which needs to be controlled. So the ex-president is behaving like this, so it is dangerous. Now the markets will go up and down, etc., etc. But your goals are not changing. Your son or daughters going for graduation will not change.
True.
So you have to build your wealth through this emphasis, through this crest and troughs. So if you don't maintain discipline, if you cannot manage your behavior, a professional's job or our job in this journey of investments is largely behavioral management. Yeah, we get a lot of knowledge about funds, which stocks, etc., etc. But if I can't manage your behavior, none of that would matter.
True. And the creating wealth is one thing. Somebody has wealth. Now to manage wealth is another thing. Like if I want to reach to some point, that is one aspect. If I am already there, to manage this is another aspect. Now, in this era, we have so many of influencers floating in YouTubes and other social medias. What is your advice to specifically to them who are more on managing their wealth? What are the things they should follow, they should do?
I think firstly, you should shut your eyes, ears largely to influencers. You must be having the ability to filtrate whatever is being said around. Please bounce it off with professionals. Please bounce it off with your backed up knowledge, because a lot of things that are being said and spoken about is sometimes not relevant to you. Even if it is relevant, sometimes it is not applicable to you. So you have to be very careful about the role of influencers in your life.
It should be
They are there.
fair enough.
If they have some knowledge to spread, listen to them. Please verify them well. There is a lot of garbage in and garbage out that happens there. And if you are not able to judge them and just take them on face value, and I'm not trying to put anybody down, I'm saying that please verify every knowledge that is been spoken. Even there are influencers who have nothing to do with finance.
Yes. They do not have even financial degree.
No,
finance degree.
and they don't have any knowledge on that. So they have picked up one aspect from the overall piece, from the jigsaw, and they're talking about that. So you have to be very careful, because these kind of misleading knowledge can be not working for your investment journey.
True. And since you are managing like about 1,100 crore asset class, like assets, the value, what is your advice to someone like at 25 years or 27 years, if they want to buy a house, should they buy or should they be on rent? Because we hear these days that, buying versus being on rent is having a huge debate. What do you think that investing in real estate asset class, is it a good option or is it?
So everything has its own time and space. I'm not saying that real estate buying is absolutely no in my books. It's a part of a overlap. So there are 4 asset classes. Let's define.
Yeah, if you can clarify like 4 asset classes and how much allocation everyone should have.
Yeah. So let me define what are the 4 asset classes. So 4 asset classes. One is debt, which is kind of a fixed income, the post offices of the world, the fixed deposits, etc. The second is equity based, which is mutual funds, direct equities, PMS, etc. Third is real estate, property, land. And fourth is commodities, gold, silver, largely, if you don't include crypto, etc. in this. So real estate should be bought, but I think you must first, because largely, real estate in India is a liability-based asset. Largely. Nobody, a youngster at 25 wouldn't buy a house on his own money because he's not generated that money.
True.
Right? So it's largely a liability-backed asset. When you bring out a liability-based asset, your liability starts building on you. Your ability to invest reduces immediately. So I think you should buy a house at some point of time, but I think first you need to grow your wealth a bit before you buy a house. Because the size of an asset like house is much larger than anything else.
True.
So if you to buy a house, maybe it is a 70 lakhs, a crore or something like that. But if you can start buying investment, other asset classes like SIP, mutual funds, equities, etc., you can buy with 5,000, 10,000. So a large chunk of your money goes towards an asset which is very large in size, blocks your ability to invest further. So you have to be extremely careful. There's no harm in paying some rent and staying the first 10 years of your life in a rental property, and then start building your down payment a bit so that your loan quantum will be reduced. And that's my way of thinking. If you remember, when we were younger and our generations before that, my father built up a house after he retired.
Yeah.
Because he had the money from his retirement corpus and he built a house. All this time we were living in a quarter or a rented place. The theory has completely changed because there is so much of peer pressure. Amit has bought a house in Bombay, with 3 bedroom, with 2 balconies and 2 kitchen and a maid's quarter. Why are we not buying? So that kind of pressure engulfs us.
And so do I go for it?
Yes. And as a family, you will be pressurized to do it then.
Yeah.
And then parents also start saying that, Arey, what have you done? You must have a house of your own, etc., etc. So as I said, there is a negative factor to building a house with a large loan at the beginning of your life. It can be done at a later point of time when you have built up your down payment to a sizable extent. And then it's easier to buy a flat or a house, whatever.
And this 4 asset classes, as you explained, now I'll double click on equity. Now, equity can be invested through direct stocks or through SIPs. Which one you suggest someone should go for?
So if either you have knowledge on sectors, stock specifics, you know how to read balance sheets well, you know what cash flows are doing, how P ratios work, etc., you can buy stocks on your own. I have no problem in that. DIY, do it yourself, is okay with it. But if you don't know them, don't go by hearsay. Then you give it to a person who is a professional, who runs a mutual fund vehicle, and he will get your money invested into a basket of stocks. Far more safer because you get a basket of stocks together with a small size, pocket size. Whereas in direct equities, you have to shelve out more money to buy more stocks. But if you do have the knowledge and you have the expertise, then it's fine. But just to hear somebody say that you should buy this stock because this stock is going to do 5 folds or 10 folds, etc., is not the right approach. And that's not how. And people get lured because of that. As you said, the last question on influencers, etc. There are so many people talking about this stock going 15 times, 20 times.
Like
and
multi-bagger
stocks.
Like this term are being sold like anything in
Right.
any social media.
Right. So that's a dangerous thing. Because if you know which are the multi-baggers that easily, you could have invested all your money and made a lot of money. Why do you need to spread that information to everybody? So I feel that keep away from them. People think that equity always makes more money than funds. Sometimes it is not so true. Funds will obviously average out a bit because it's a basket of assets. You will also have a basket of assets when you build your own equity portfolio. But without knowledge, there's no point in spending a lot of time here. Because you will spend time out of your expertise here to manage that equity portfolio.
True. And SIP, the mutual funds. So mutual funds, and like, I mean, again, with my very little knowledge, I heard once that for small caps, we always should see the AUM. It is as low, it is as good. If it is low, then it is good. Whereas for a large cap, the AUM is the higher the value is, the better it is. Like that. So I want to know from you, like for the audience who are watching this, like if somebody wants to invest in mutual funds, let's say large cap, mid cap, or small cap, what are the three things they should see before they pick the fund, they choose the fund?
So, large cap, mid cap, and small cap are based out of the fact that their market caps are in that manner. As defined by governance, they say the top 100 stocks are large cap, the next 150 stocks are mid cap, and the rest everything is small cap. As you said, AUM is one factor that you must check. Very small AUM means less of liquidity. A large AUM means more of liquidity. Easily redemptions, etc. can be processed. Two is that you need to find out what fits in your portfolio based on your risk appetite. To give you a little peak view on that, for example, a 70 years old person should not put a lot of money in small cap, because small caps are more volatile. Small caps are new companies, so they are more volatile. Mid caps are a little lesser, large caps. So they probably would like to go into more of large cap, more of balanced advantage funds, which are a mix of debt and equity kind of things. So I think based on your risk appetite, your choice of fund should happen. Third is that you must see what kind of consistency of returns they generate. It's not last year return, 2 years return, etc. How consistent are they in terms of? You don't have to be number one fund to be chosen.
And when you say consistently, how many years of return they should?
I think you should look at 5-6 years of return and how consistent they were.
Okay.
I mean, a fund is number one in one year, and in year 3 you see it is in the third quartile. So that kind of funds is something which you're not looking for. You're looking for more of consistency in your funds. I think if you look at 3 basics, then there are expense ratios, etc., etc. you can look at. But I think you're right, AUM is something which is important. How the funds fit into your profile and your goals is important. And third, I think, the one that I just spoke about.
And as you said, 5 to 10 years or 5 to 7 years of consistency we should see, at least. But what if it is a new fund? Let's say before 3 years it launched. So should we avoid to take this fund, or is there any other parameters we can still see and check it?
No, we can. So one, that we are not comfortable to promote any kind of new fund offers. Because for us, new funds offer are unknown.
Right.
It's not coming to business, so there's no historical evidence of it, how it will do or not. But something which is maybe 3 years old, just being 3 years old, young, and not as old as maybe 10 years old fund, does not really mitigate its chances being allocated in somebody's portfolio. However, we'll go in depth into the portfolios that they're holding. What kind of stocks are they holding there?
Okay.
Is it extra risk? What kind of risk are they taking? What kind of risk-adjusted return are they delivering? So for a younger fund, we'll be more in depth into their portfolio to judge whether we can allow them in any of our clients' portfolio.
I remember one story, like it was very funny. When I started my investing towards mutual fund, so with a very little knowledge, what I did, I took two small cap funds. And I'm not taking the name because it's not a sponsored video. It's not a sponsored video, so that's the reason.
Right.
And what I did, I tried to see the holding, because 2 small cap fund, then I found that all the holdings, like let's say 10 companies, 8 are same in both the funds. Then I realized then there is no point of investing in two small cap funds. Then I switched the fund to other fund.
Absolutely.
And I did the difference. Okay, now out of 10 companies, 4 are common, but 6 are new.
Absolutely.
So we should go for it.
Absolutely.
But this is again from a very novice thought.
No, very, very unique thought, because a lot of people don't do that. So people have 30 funds. 30 funds are commonality 60%, 70%. So in our tracker, we have a system which can identify what are the common stocks in each of these funds that you're holding. Then why are you holding 10 of them? So I think you should negate that.
Now we have talked about mutual funds, stocks, direct stocks, the real estate, the asset classes, the good thing and bad thing about real estate, the decisions behind it. Now we'll talk about wealth psychology. We have heard a term called financial freedom these days too often, especially for corporates who wants to retire early, like FIRE number and all of these things. What do you think? How much is too much? What I mean, how much is too much? If I have the X amount of thing, I know, again, basis of monthly expense into so and so numbers, that formula. I'm not going into that thing. What I'm saying is the financial freedom. If somebody have to achieve, how much is too much?
So let me put it this way first, that everybody is wanting to, as correctly put, achieve financial freedom. But what was the definition of financial freedom 5 years back is continuously changing.
Absolutely.
So at what age do you want financial freedom? That's primary. Because in a financial planning process, if I don't know the time frame that is available to me, it will become extremely difficult to construct a portfolio to take you there. We'll come to the numbers later. So earlier it was like we used to say that you work for 30 years and you live for 30 years and so. So you used to join a job at 25, then you live till 60, 65 or 55, and then you live for 85 and it's fine. What has now happened is, because of the job circumstances that are available, and it's not only India, it's actually spreading worldwide, that your working life is reducing.
It's no longer 30-30.
It's no longer 30-30. So if you start your career at 25, 26, then you're lasting till maybe 50.
Sure.
Yeah. So your period of your working life, and so your investments and savings are actually declining. What is happening in the contrary is that your living life is increasing. We have got a lot of advancement in terms of medical science, etc. So we will continue to live longer if you have the money. So maybe earlier we used to say 30, you might live for 40 years. So your working life is 20 years and your sustenance period with that 20 years investments and is 40 years. So it's getting more and more difficult. I just answered your question on a number, that I think 5 CR is a good number. Between 3 to 5 CR is a good number to settle. Because inflation will also continue to grow. So when you retire, maybe you've got 3 CR and it looks all okay. You can park it in a fixed income at maybe 6-7%. Then you get around, say, 1.6, 1.7 per month. But 10 years down the line with inflation, that will start looking smaller.
With that new purchasing power.
Yes. So with inflation, your purchasing power will start going down.
Yeah.
And if you live longer, that process will continue. Second is that there can be escalating expenditures which might happen. New things will come. Say 10 years back, 10 years, 15 years back, we didn't have a smartphone. So smartphone is an extra addition in our life.
And which is getting upgraded
every
once a year or twice a year.
So
in 2 years interval. So again, that is added cost.
Added. So there are similar many things that are happening in life. So there's exported expenditure which is coming to your life, plus there is a regular inflation that is there. So I think you need to do a little more than what you are supposed to generate as a corpus. So I think if you look at number, 3 to 5 crores is a decent number to at least start it.
And this 3 to 5 CR, this range, once someone has that number, and as you said, like sustainable period is getting more, to park this thing, there are 2 options which I heard it earlier. One is SWP, like SIP there is SWP, systematic withdrawal plan. And there is another thing is, we will not, so SWP will go one fine day, it will be 0 if it is not the 4% rule, it is not being maintained with the 4% rule. And if it is with the 4% rule, then the amount which we can withdraw per month is very less, because that's a 4% over the year. So what do you think, to park this 3 to 5 year would be the wise decision? Is it a mix, or if it is mixed, then where and where? And if it's not the mix, then which tool is best? Which way?
So we like SWP as a methodology of withdrawal. We don't so much like locked-in products like a pension plan, etc., which gives you cash flows. We like SWP, which gives you full liquidity. But the process of SWP should be very nimble-footed. Don't go for any particular strategy. I think as you start your SWP in your life, it should be smaller quantums. As you go over it, so if you've crossed 70, 75, 80, your days of living, and it's a unfair truth maybe,
Of
that
course.
you will have to go someday, but your period of living will reduce. Then you can actually start using your SWP. Sometimes we say when you're 75 plus, even if you eat out your principal, it doesn't matter.
True.
Because your time frame is rather limited.
Getting shorter. So
Shorter. So even if you spend a little more, I'm okay with it. But if you start taking a SWP at the beginning of your retirement journey in a very large quantum, then there is high chance that you will start depleting the capital. So what we advise our clients is start slowly, and then you start building up on your SWP. Every year or every couple of years, you start reviewing your SWP percentages.
So assume that there is a person who's of 45 years or 50 years of age. He has 3 to 5 years of corpus. That person with the 45 years, where to park it and how much he should withdraw? The person should withdraw.
We suggest that don't withdraw anything more than 5 to 6%, largely 5%.
Okay.
2 is that we also say that as you're younger, maybe you can have that little risk appetite where we can park it in equities, but your portfolio will be spread across different asset classes. Because you're retired.
Not only into equity.
No. So if you put everything into equity and there is some big debacle that happens, then you're withdrawing still. So you might eat out of your capital. 1. 2 is that you don't have any fresh cash flow to compensate or average out of any side of downside.
Right.
So we feel that even if it's retirement at early age, the spread should be across different asset classes. Only thing that if you retire a little younger, then your equity exposure could be more because that much runway we have. But it doesn't mean that you will have 100% equity in your portfolio. Say there will be debt and there will be other asset classes.
Now, with debt and with a market, will there still be the real estate and gold and all other asset classes, or that should be reduced?
So when we talk about commodities like gold and silver, everything is now paper gold and silver. Physically, largely people hold for consumption. But investment purposes, mostly it's paper. So you should have some amount of gold and silver because they're a good hedge. When everything does badly, then as you have recently seen, that gold and silver did significantly well. Now crude is doing significantly well. Right.
And you are assuming that so you're suggesting 5 to 6% withdrawal in
maximum
per year that person can do. And you are expecting how much in what rate it is growing, the whole thing?
So if you have a mixed basket, with a little overweight on equities, then I think we should do around 9-10%.
19%. So with that formula, the person will never run out of money.
No, he will have 3-4% buffer build up every time, and he will continue.
Once that person, let's say he is 45 years today, at the age, once he will reach 75, that money will significantly grow.
That's right.
By the time.
That's right. So also it will depend on your individual risk appetite. Some people might say increase my equity, try to get the overall return to up to 12%, etc. and things like that. But I'm saying in general, this should be the strategy that you try to give him 5% and generate at least 10% in a basket of asset classes over longer periods of time.
In recent times, I heard somewhere in YouTube, I'm not sure if it is which one, but I heard somewhere and I read also that SIP won't make you rich. Only SIPs only will not make you rich. Do you agree with this, or do you have a different view?
So no, SIP will make you rich. But I think you should be intelligent enough to perk up your SIP. So there is something called a top-up SIP, where every year a 10% or a 20% enhancement in an SIP will happen and things like that. And SIP is not a product. SIP is just a process. So your spread across different asset classes must continue over periods of time in your investment journey. So maybe when you started your career, you didn't have enough money to park everything everywhere. You know what I mean? So maybe you had started SIPs and you had created a protective plan and taken a term plan for your dear ones, for your family. As you've gone through that journey, you would have or should have picked up other asset classes as you crossed that journey. So you would have picked up real estate at some point of time. You would have picked up debt at some point of time. You would have picked up commodities at some point of time. And different mix of asset classes you should have actually picked up. So just saying that SIP only will not make you rich, it's not that true. But I am saying that SIP is a methodology of attaining a corpus, and you use other methodologies also to build up your overall wealth.
And so gradually, like once you start with one vehicle, after reaching some point, you start with another vehicle. That.
And then parallelly, your income also grows. So it opens up another vehicle space. Then you start building. So once you had started just give an example. When you started your life, maybe my salary was 30,000. So I could have only done 10,000 SIP. But when my salary went up to 2 lakhs, then I bought a flat with a EMI. Then I bought some ETFs in gold and silver, etc. So your basket will constantly increase with your growth in income.
Right. And what are the biggest misunderstanding about investing SIPs? What people have? What you have seen in your client space that they have the biggest misconception about SIPs?
So one of the misconception, which is, very true, and if you ask 100 people, I don't know what kind of response you will get. A lot of people think SIP is a product. First of all, SIP is not a product. SIP is just a way of investing. Systematic investment plan. So it's not a product. Now, a lot of people say, come give me an SIP. SIP is a process.
SIP can be on mutual fund. SIP can be on
anything.
Anything like the gold, like stocks. Right.
SIP can be on anything. SIP is a process.
Right? So everything.
But when we say in a bank, when you go, you say recurring deposit.
Recurring deposit.
What is a recurring deposit? It is making a fixed deposit every month.
True.
So recurring deposit is just a process of making fixed deposit every month. So SIP is a process of buying a fund or a stock or a commodity on a regular basis. So that's a big misconception that one has. Secondly, it is between misconception and not understanding is that people feel or do SIPs when the markets are up, when they're down, they continue to stop the SIPs, which is the worst kind of situation that can happen in an investment journey. The whole concept of SIP, systematic investment plan, is to buy cheap. You can only buy cheap when the market falls.
You will be able to accumulate more
many cheaper units. So your overall average cost will drop. But people feel the markets are down, let's stop the SIP, and when the markets will go up, I will restart again. That's completely a wrong concept of SIP. If you've started your SIP, please pray that the market goes down so that you get cheaper units when the markets are down.
And over the long run, it can create more wealth.
Completely. So the problem with some of the investors are that they don't understand what is a long run.
Right.
Even 2 years of good market, they feel that's a long run. 1 year of bad market, they feel it's too much of a pain that's happened. An investment journey of an SIP should be looking at 10, 15, 20 years. So you will get a lot of obstacles on the way in 15, 20 years. And because you ride these obstacles, you make more money than a lump sum investor. Because you have averaged out your cost. Had the markets gone up in one singular direction upwards, then why would you do SIP?
Then everybody will be.
Yeah, so you make a lump sum investment and stay put. Why would you do SIP? So SIP is done on two purposes. SIP is done because your cash flows are like that. You earn money in that manner in a staggered fashion. Second is that You put money so that in bad times you accumulate more units.
Right. What you suggest that somebody wants to invest in mutual funds, but they have less time. Now you all know that with less time, we should not be invested in market. What is the less time? Like, what is the threshold? Like, if somebody has 3 years, can they invest in mutual funds?
No, they can invest in mutual funds. In mutual funds, there's various categories. So I would believe that somebody who has 3 years time is not good enough for equities. They might have to look at balanced kind of funds. I'm looking at least 5 years plus for equities in terms of horizon.
Okay.
Because market will remain volatile. If you need that money at exactly after 3 years, if the market is down at that time, you might not get. So I planned my daughter's marriage after 3 years, and after 3 years, I see the markets are down.
Then there is no use.
No use. So market normally 5 to 7 years they recover in itself. There have not been seen that long phase of market downturn over that 7-8 years of time. So 5 beginning to 7 to 8 years is something that I'm looking at in terms of horizon to park equity money. In a shorter horizon, you can park it in debt, which is low volatility. Anything interim, you can look at balanced advantage, equity savings, which are a mixed basket of debt and equity.
We have seen the example of another use case, which already we discussed about 45 years old with the 3 to 5 share corpus. Now, it's a different use case. Say, for example, somebody as a 30-year-old comes to you and with a 10 lakhs of cash. What are the things you would warn to the person, and how you would advise that person to invest those 10 lakhs?
So if he's young and he has a decent risk appetite with not too much of liability outstanding around the corner, then he will have to or should be more exposed to equity rather than debt. But what we warn him about is that he has to run this journey of 5, 7, 10 years with that money. So his target goal for this target money should not be very short term. And more exposure to equities, because he's young, he can face the volatility. He has enough time in hand to ride through phases of volatility. So 2 advices that we put in front of him is that 1, you should wait that time to make your money grow. You should not look for quick money and then withdraw after 1 year if you've made some little bit of money, but if you're losing, then you bang your head against the door, etc., etc. So hold that money for a longer period of time. And since you're young, and if you don't have too much liability around you, then I think you should look at more of equity. Okay. Equity and its sub-products.
Okay. And you said sometimes back about term insurance, and any kind of insurance should be taken as a protection plan. Now, one thing is most underrated. Many people oftentimes missed about emergency fund. If somebody needs money on an emergency basis, they will probably in a soup. What is your advice to build the emergency fund, and how should one create the emergency fund, and what is the minimum time period or the best time period they should park for?
So we as advisors always have said that emergency fund should be for 3 to 6 months of either your income, which is on the higher side, or at least your expenses.
Okay.
So a lot of people say, why should we park so much of money in a separate place? And I'll come to that, what kind of products should we use there. But, this was very transparent that what is the need for an emergency fund was during the time of COVID. Okay. A lot of people lost their jobs. A lot of people were struggling. A lot of people who were doing small scale businesses did not have any income coming. So to run your regular fire in the kitchen, you need to have that kind of money.
But 3 to 6 months of what you said, the income. Expense, I understand there is expense for 3 to 6 months, which could be risky in this scenario. But 3 to 6 months of income is a huge amount.
Yeah. So your first priority of your investment should start with building an emergency corpus. Normally we deviate towards building our wealth, but the first thing that you should get out of the way is building of your corpus of emergency. And why income? Why not expense? What is the difference between accumulating emergency fund of
Right.
expenses, totaling of expenses and not income? Why I have said income is that sometimes people have investments in from their regular income, right? You're doing SIP. So if you have accumulated an emergency fund during that phase of 6 months when you're without a job, even you can run your investments. You can pay your premiums. You can pay your EMIs. You can pay. That's why income
It's the best option.
best option. But if you can't, at least expenses.
No, honestly, I mean, this is something new I'm learning because I haven't heard ever. Everybody talks about expense into X number of months, but income into X number will give more leverage. As you said, paying the EMI, even continuing the investment.
SIP, you have a running SIP.
Yeah.
You feel that you need to pause it for 3 months. I will not pause it if I have my
Your income.
in my hand. But after 3 months, if I get my job, the continuity will remain. So you want to make it continuous.
True. And as you said, that you would suggest what products people should choose.
So you can't have a very aggressive product in these kind of funds because utility of the funds, though unknown, can happen anytime. When can it happen, we don't know. Emergency, that's why it is called. So we would prefer to have it in a fixed deposit or a short-term debt or a liquid fund in that form. Sometimes it also so happens, and we are talking of only job losses, etc., etc. What about sudden emergent medical?
True.
Everybody, we can come to that, but everybody does not have the proper mediclaim in that manner. Some parents have never done their mediclaim. The history, India has been a poor mediclaim absorber.
But even if somebody have, most of the times the charges in ICU is so high.
You have to pay from your pocket.
And then the co-pay policy.
Yeah, the co-pay, there are limits to your policy, 1% of room rent of your overall policy.
Yes.
So it can be anything. And there are certain things in life which are very unknown. And you don't know when these emergencies will come, what will happen to life, what it changes. I think that 6 months is extremely important. People ignore that. And I can promise you, out of 100 people, 98 people don't have an emergency fund at all. They're not even earmarked to that emergency fund. They'll say, I'll break my fixed deposit when it comes to that. But fixed deposit was kept for his son's education, maybe. So you're playing around with the baskets. You're dipping into any baskets that you feel that whenever the time comes, you can dip into. So your Darjeeling travel can go out of your retirement corpus also.
Yes.
So I think emergency should be streamlined, clearly demarcated, and kept separate.
And the best is to keep it as a debt funds.
Largely. Because you don't know when the emergency will come. It can come tomorrow, it can come 10 years later. Best case scenario, you can split it into 2 parts. Maybe one part you can take a little bit of risk, but largely it should be kept as safe as possible.
Okay, so we heard about the best vehicle to manage the things of finance. Now we'll talk about more on India, economy and markets. Now India is often described as a growth story of this century. What is your viewpoint and do you agree with it?
So, India has a lot of pluses in its place. It's got a population demographics which is very young. You look at any other country, there are much older population in terms of demographics. So our ability to consume everything is very, very high. We are slowly moving towards doing manufacturing so that we can supply to the world. So in terms of positivities, there are many positives that this economy holds. However, there are also bums, rail guards that are available in this economy. And this war has shown us that how effective it is to be dependent on oneself. One of the biggest concern area is energy. We are still dependent on other countries for energy. We are also dependent on the pricing of energy, the cost of energy, because everything that we buy crude from is outside and the price goes up. Large portion of our expenditure goes out. So if we can solve some of these problems like energy, etc., self-sustainability there, and can increase our exports in terms of outsiders, we are a country to reckon with.
The theme like Vikshit Bharat 2047 mission, towards this journey, what are the things you are worried about that it may reach to that point, or these are the things I'm worried?
So I am worried about a few things. I'm worried about the fact that our technology has not moved to the extent that we should have done. There you can see what the world now is. All the economies are, whether the valuations are correct or wrong is a different question. But in terms of R&D, we have not done too well in terms of the technology piece. We must improve our energy capabilities. So just to give you an example, when this crude thing is happening, and this is happening for quite some time now, this outburst just now, China has been converting its electrical vehicles, almost 40% they've converted from crude to electricals. We must make a move because that's where our shortages are. Third is that I think we really pushed for manufacturing because that's our way out. But that's our area where we can really get foreign exchange by exporting. So there are concerns, but the plus point is that we have cleaned up our own house to a greater extent. Our banks are really cleaned up now. Very low NPAs, well nimble-footed. So our BFSI segment has been well constructed. Internally also we have cleaned up a lot of things that were bottlenecks in the industry. Infrastructurally also we have connected well, bridges, roads, railways, metros, etc. So all things are ready for that economic jump. So only thing is that we have to identify which economic segment that we are going to target in terms of push and which government is doing, and we must be able to sustain ourselves in terms of energy. We must figure that out in the next 10-15 years.
So what do you think, which sector could outperform in the next decade?
So I think there will be a lot of new kids on the block which will come up. For example, alternatives to energies will come up in a big way. India is also specializing in defense. So a lot of defense companies will start building up. There will be a space created in the discretionary spending space. So not normal FMCG companies, but at the higher end of the FMCG companies will be in focus. Capital goods will continue to do well. Capital markets will continue to do well. Any company which is related to infrastructure and power will do well. So these are some of the sectors I think will continue to do well. Banking will remain a core sector in the Indian economy, but I think these are some of the sectors which are growing, and then the new sectors will come up which will push the economy through the small cap space.
Okay, but if someone wants to remain invested, let's say for next 10 years, any 2-3 top performing, possible outperforming sectors, say for energy, as you said?
Energy will be a sector to really focus on. If you can figure out what are the alternative sources of energy, and there will be companies who will start bringing out those energies into place, will be in focus area. As I said, defense under these geopolitical circumstances will continue to evolve, supported by the government, but there will be companies on the private side who will start doing that. There are so many US companies who are supporting the government for defense. I think India has great aspirations. So I think the consumption space will do well. The infrastructure development will continue. So there will be a space for infrastructure as well, which will come up. And then there will be, things like capital market companies, NSCs, the BSCs of the world, they will also start evolving because people are transiting from the so-called fixed deposit and insurance era to more modernized investment zones. So many things will start evolving in the next 10 years in terms of industries.
And what are the investors should do right now? Like, should they focus only on India market, which is like as a part of growth story, or they should look for global diversification?
Certainly should look for global diversification. The weightages will not remain the same since we live in India. We know more about India. We know what companies do, how they work. So weightages in India will remain, But I think it is clear that diversification must happen in other currencies and other markets. If you see foreigners investing into India, China, etc., they are doing the same thing in terms of strategy, diversifying their risks into various markets. And as we know that every market cycles, every market does not behave in the same manner universally. So there will be markets which are doing well. For example, Korea was doing extremely well last year. Some other market will evolve. So we have to be nimble-footed to see which markets are doing well and allocate. The difficult part is to which companies do we allocate, because we don't know much about many of the other countries. So there you have to probably pick up some expertise opinions, or you have to do it through the exchange traded fund there. But currency is important. We've seen how US currency has
So dollar to
appreciated against rupee, and even US currency has depreciated against other currencies. So there is a big swap happening there. So if we don't extrapolate ourselves to other currencies, it's a loss. I was speaking to Davina Mehra, that I was coordinating a show for her, and she said the first diversification that should be looking at not between asset classes but between countries.
Right.
So that sticks to the mind that diversification across currencies and countries are important.
That's one important aspect. And what is your view on crypto? Because since it's again unorganized market.
Yeah, so crypto, we are not very certain. Government has also not created any legislation. We had heard that government will bring out its own cryptocurrency, etc. Nothing has happened. So we are not certain how it will behave, how it is controlled. And because it is data mined, there is no legislation body which can protect you if there is anything which is happening which is not normal. So we have dropped crypto out of our investment box as of now. If something evolves in the future, we will clearly look at it.
But then we saw the Bitcoin's journey from where to where.
I know.
And again suddenly
And then fall also.
Fall also. Yeah.
So that's the reason, one of the reasons that it is so volatile, and we are not equipped enough. The government is also not pushing this as an investment asset class. So we as advisors have created a distance yet, but we are ready to look at it once it comes in a formal manner.
And at one certain point of time, we noticed there has been an era that where people were more into real estate fan. It's not in terms of land, in terms of REIT. Is real estate really underrated, or is it overrated to create the wealth in today's date?
So, I mean, real estate in phases has done well, but not necessarily that they've consistently done well. The only biggest point that real estate has is its size. Real estate is largely a very bulk-sized product. Cost of buying a real estate is much higher than buying a mutual fund or things like that. Therefore, real estate has taken its position as it is today. I think real estate will remain as an asset class which you should own, but you cannot own all of real estate and none of others in that manner. Because of its sheer size, it will occupy a large portion of your portfolio. And if you bought a 1 crore property, then rest has maybe 10 lakhs, 20 lakhs, 30 lakhs. So proportionately it becomes higher. So that you have to be careful about. And don't expose yourself to 5 properties or 3 properties. Very difficult to maintain, difficult to sell. Buying is easier, selling is far more difficult. So you should be there part of your portfolio, but in moderation.
So we talked about crypto, mutual funds, and a lot of other things. Now coming back to the personal finance. While managing personal finance, at least in India, I'm not sure about abroad, but we still see that women are not completely ready to take the ownership of completely managing that end to end. Why there is so?
I think the fault is at both sides. Women have never been allowed in Indian society to make major decisions. If you go back to history, you will not find that a purchase of a property or a purchase of something significant has been really consulted broadly, or the decision has been taken by a woman. That's the side of the fault that we have had. The woman's side, the fault is that they never want to come out of that domain. They think that domestic liabilities are the only liabilities that they have, and they did not know what wealth the man of the house is saving. However, it is kind of changing because now in most of the houses, both parties are working, men and the woman.
Even in like working women, we still see that they are working, they are getting salary and everything, but they are still relying on the main breadwinner or husband probably to manage this.
I think mentally they have demarcated their job profiles.
Yeah.
They feel that the husband's job is to look after the financial part of it, and the wife's job is to look after the house and the children. I think at some point of time that must be shared. As we say that the investment must be looked after by the woman, it is also that men also should start cooking a bit from the house when the
Right.
woman is tired.
The shared responsibility.
Yeah, shared. So abroad that is clearly visible. In India it is still evolving, and I think it will take some more time to them. However, I'll make one point here. In my journey of investment advisory, I have seen in most of the instances the woman of the house who dragged the men of the house to an advisor, saying that maybe I don't understand much of finance, but I want my savings, my future, and my child's future to be
To be
secured.
secure.
So the woman of the house is more concerned, more targeted towards budgeting, etc., than men are.
Yeah.
However, they leave the responsibility to the men of the house to take care of the rest. But I have many instances where women have dragged the men to come to me to understand what's happening.
And other than that, it would be the risk. Like if something happens with the men of the family, then if the woman is completely unaware of the asset classes where the person is investing on and also other things, then there will be the family would be at risk.
Supremely at risk. In many cases, there is a great chance of deceivement also. If you don't know where everything is. So it's important for an advisor first to collate everything on a sheet of paper, bring the husband and wife on the table and say, this is what you have. Please note. From here we will grow further, but this is what you have.
Sure.
That tabulation is extremely important. Many people invest, don't even tabulate what they have. If I ask them, tell me what are the investments that you have, they can't figure out immediately because there is nothing tabulated on a system or even on a paper or a page or wherever. So how will woman know? So it's important for the woman to know, because in case anything happens, and most of these cases something happens quite suddenly, then they are in a big soup. They have to go from pillar to pillar to figure out how this could be revived, etc. I think two things are important. The role of an advisor is important in your life, just like a family doctor or a family lawyer.
For more awareness.
That's right. More awareness, guidance. In future, if something happens, who will take you through that process? Because a digital platform will not take you through that process.
True.
Because there's no emotions also involved in that. Second, I think the woman must attend all the investment meeting almost all the investment meetings that they have with their investment advisor.
Absolutely. And as we talked about women's literacy towards financial education, I believe it is equally important for the kids. The parents should teach their kid about personal finance from the very early age.
Very, very important.
And so what is your view and your take on this, that how parents should do this?
First of all, let's feel that it is important.
And of course, without being dragged into the long conversation or long lecture format.
No.
And kids should not even be knowing that, okay, which vehicle is, which asset class, what vehicle and everything, where is its part. But how that can...
No, so I had written an article in one of the major leading newspapers on this, that what is the role of finance in a child's life. Firstly, we hardly, specifically as a Bengali or Indian, we hardly discuss money matters on the dining table. We say, hey, there are children, let's shun this off. But the lifeline of all our lives are money. So it is important that money must be discussed. Money should not be discussed in a very complex manner to a kid. How does he understand? So it is through games and plays that one can teach your children about money. For example, I'll give you an example how I wrote that article. I said, give your little money to your daughter, not in a physical form, maybe in a token form, and say that how do you spend this money? You can only do 30% of your own needs, 30% for toys, etc., and 30% you must donate. The thought of donation also must come in their mind.
Yeah.
Or you can create a piggy bank for them where they come deposit, and every after 6 months, 1 year, they break that piggy bank or take out that money and again distribute to buy something of their own, 30% there and 30% there. So it's a understanding the value of money. Or you ask them to do a little bit of shopping. Give them little money and say that you go there, what will you buy, how will you, calculate how much you have bought 4 toffees for what price. So it teaches you a little bit of mathematics, it teaches you a value of money, it teaches you how exchanges happen, etc. So playfully, you have to start teaching them how the money works.
Absolutely. And on what age what age of the child parents should start doing this?
I think 5-6, class 5-6, you must start talking about a little bit of money.
Before that, they don't have maturity.
No, they will not understand also, it will not register also. Wants and things like that will come after only class 5 and 6. And then you start talking about a little bit of money. What is the importance of money? Discuss with them that we are going for a vacation. How do you think we should spend? Where we should spend? That kind of things. Get them involved in your discussions of money. Don't go overboard of discussing mutual funds and stuff like that with them, because that'll be very boring for them. Yeah, that's not what they're looking at. But if they involve that we are going for a trip to Kashmir, and you tell me what we should take. We should take a flight. Okay, is flight more expensive than train, but it will take longer or not. Get them involved in a game of discussion.
Right.
And I think children actually enjoy these games, and they will learn from there. Surprisingly, in our academics, there is no subject of money.
No subject, and that should highly be included.
Very much, and that's why we come up with people who are, as you said, intelligent enough in their academics, but poor enough in their finance.
Yeah, true, very true. I'll now ask you something very interesting. Since you have been managing for the finance, the portfolios for about last 3 decades with a huge size, have you ever met with kind of big investor of India? How was your experience? Can you tell us?
There are superb experiences. So I met Rakesh Jhunjhunwala at least 2-3 times in my life. And the conversations are so dynamic, so unique. And, the way they think about money, way they look at money. And I've met some of the top fund managers of India. They come for my event also. And when you discuss with them, their way, the thought, how they look at the markets, how they look at stocks, how they look at demographics, how they look at international markets, etc., are extremely unique. I just want to share something that Rakesh Jhunjhunwala had done, that budget where Narasimha Rao was placing his budget, and he said that whatever money I had, I think he had 1.5 crores. And everybody, the people who are as renowned as him, like Damani, etc., were saying that this budget will not go well. But he backed his gut, he did his research and put that entire money. And end of the next day, he was almost, I think, 20 crores odd in his account.
Wow.
So these people,
Prediction.
even if you read through Warren Buffett or you read through Morgan Housel, the psychology of money, so they think differently. They work hard for this. They are not investors by hearsay. They do their own research and they follow extreme discipline.
So as you said, 80 to 90% of discipline.
Yeah, and they are not so greedy, they are not so fearful. They have a great, unique balance to make money. So I've met some of them and they are what they are because they are that disciplined. now.
True. I'll now go into some rapid fire questions to you. Mutual funds or direct stocks?
I prefer mutual funds.
Wealth or freedom?
Freedom.
Gold or equity?
Both in different percentages.
And if I ask what percentage?
Equity more, gold less.
Yes.
But percentage.
Percentage, yeah. But SIP or lump sum?
Both. SIP for some people who are starting their journey, lump sum for some people who have accumulated some wealth and get money in a go.
Okay. Real estate or equities?
Real estate in moderation. Equities for growth.
Okay. One financial habit every 25-year-old should start today.
Start investing. Forget everything else.
Yeah.
This dilemma of just going ahead and investing takes months and years. So just forget everything and start investing.
One financial product every Indian should avoid.
Should avoid.
Should avoid.
You can't say one can avoid any single product. But I think, if you look at earning products, I think gambling should be avoided. But otherwise, every product is available for every
But if you
risk.
consider crypto as a product, then probably we should.
Yeah, probably yes. If you think that crypto is not an established product in India yet, then you drop crypto. But otherwise, every product is available for different risk appetite people. You just identify for whom and why.
Biggest market myth?
Biggest market myth is that one that insurance is an investment product is, I think, a big market myth. Because everybody tries to show what are the returns in that product rather than what is the protection in that product. That's a big, I think, market myth.
And biggest personal finance myth?
Biggest personal finance myth is that people think that we can't become rich. You can become rich. If you're disciplined enough, with small quantums of money also you can become rich. And I have plenty of examples in my journey of 30 years.
Yeah. One book everyone should read before investing?
One book?
One book?
Oh, there's so many from Warren Buffett, which everybody should read. I like Morgan Housel's The Psychology of Money.
Psychology of Money. Yeah.
I like a lot. You must read Rich Dad Poor Dad.
Rich Dad Poor Dad.
Yeah. So there are so many books that are there which you can read through.
We have discussed so many things in today's episode, and I'm sure viewers are getting quite a good knowledge out of it. Now we are almost towards closure of it. If I ask you that what financial mistake, if you think that you would avoid in your early days?
I think the biggest disadvantage that people have when they start their journey is they start accumulating property, etc. at a high liability cost. I think that seriously should be avoided at the early part of life. It should be that you start your investments early and start building up. If you make money, serious money, you will get your real estate portion or car or a big car, etc. will all happen in due course of time. But in this world of competition and peer pressure, we, I think, start buying the assets which are backed by large liabilities before we start our process of investing.
So peer pressure is playing out of.
Yeah, because everybody says that why don't you have a flat? You should own something like that. And then you start doing that. You're packed with liabilities, and you will realize all of that after you've crossed that 20 years period, and then realize that, oh my God, I've prepaid the loan of 20 years, but I've not accumulated money. Now I only have a house.
Right. And what's one finance lesson you learned too late?
So all that I'm discussing, I've learned in life.
Okay.
Because, sometimes when it is in your journey, it hits you more. But you know what advantage I had? I recovered quickly. I realized that it was a mistake and I started recovering quickly. I worked hard on myself so that I could improve as a person to make more money. See, end of the day, you must realize that you are the person who is going to make the money. And the money must be deployed well so that you can grow.
Sure.
So you should put as much effort on yourself that you're putting even on the markets. So I have recovered, but I made all these mistakes, and I'm no harm in saying that I've learned from mistakes.
You learned it in a hard way.
Yeah.
And What's your thought on this? Like a 70, as it is said that money can't buy happiness, money only can't buy happiness, but at the same time you should have enough money. So what is something 70 years old understands better, but 40 years old don't often understand? What is something about finance or money?
So a 40-year-old cannot see what a 70-year-old has seen. So that vision a 40-year-old doesn't have, that at 70 what should be my positioning. One. Two is that I think at 40 we are not minimalistic enough. We have too many repetitive things.
Yeah.
You open your wardrobe tomorrow,
Yeah.
you will see multiple of shirts and trousers there which you probably will never wear.
Yeah.
So we are not minimalistic enough when we are at 40 because we like that. We feel that that's something which adds color to my life. But at 70 you will start behaving more minimalistic. And also at 70 you will realize what mistakes you made in your life or did not.
Completely agree. And it's such a fascinating discussion, and we all learned a lot of things from you. So I would request for our viewers to share top 3 tips, irrespective of age group. The person may be at 25, person may be at 35 or 45. What are the 3 top things they should?
I think you should continue to invest. Don't stop because there are volatile markets, etc., etc. Continue to invest because it's your journey, it is your goals. Remain disciplined. Remain extremely disciplined. Don't look at or hear the sound that is going around you. And 3, I think you have a family to look after. Make sure that everybody gets the best of their life through your decisions. These are 3 things that are important.
Great. Thank you so much. And it's our pleasure to have you here.
My
for the
pleasure.
interest of time.
My pleasure.
We have to take a pause here, but I'm sure there will be another discussion with so many topics, because finances itself is a vast topic. Yeah, so a lot more questions, lot more things.
Sure.
So we'll
Thank you so much. I had a wonderful time chatting up. It brings out so many memories and brings out your experiences, etc. Thank you so much.
Thank you from Breathing Edge.
Thank you so much.
Take a moment. Reflect on this conversation, because sometimes one idea is all it takes to change everything.